Uh, Greetings, everyone. We're here to present our restructuring recommendations for Office Properties Income Trust. Our analysis focuses on identifying the causes of the company's distress, evaluating its capital structure, and outlining a transaction that restores solvency and long term viability. We'll begin with a brief overview of the company. OPI owns 124 wholly owned properties totaling about 17.3 million square feet across the US. The business model centers on long term leases with government and investment grade tenants, which historically supported a leveraged capital structure. That foundation is now under pressure. Roughly 7.5% of rental incomes rolls off next year, while re-leasing costs have surged. Leasing activity in the current market requires tenant improvement allowances and commissions that consume liquidity before interest, pushing cash flow into negative territory. Occupancy has slipped to about 85%. Debt stands around $2.4 billion and about 280 million matures next year. With the office capital market effectively frozen, refinancing options are limited. Yeah. Here we break down the issues into business, financial, and capital structure challenges. On the business side, lease rollover exposure is significant. About 7.4% of rent expires within 2 years. Tenant concentration is high, with 76% of revenue tied to government and investment grade leases, meaning the loss of even one anchor tenant immediately hits the NOI. Asset sales that might have reduced leverage have failed, with bids roughly 55% below book value. On the financial side, liquidity is strained. As of June, unrestricted cash was $78 million, with over 900 million of maturities through 2027. The company spent nearly 40 million on improvements and leasings in the first half of 2025, and 72 million remains committed. Finally, on the capital structure, leverage exceeds asset value. Debt of $2.4 billion dwarfs equity of roughly 50 million. And with maturities clustering in 2025 and 2026, the current structure is not sustainable. Here's a breakdown of the capital stack. Total capitalization is $2.48 billion, split between $1.9 billion of secured debt and about 490 million of unsecured debt. Secured facilities include a 425 million revolver and term loan, both fully drawn. 1.3 billion of senior secured notes with coupons up to 11% and 177 million of mortgage loans maturing through 2033. Unsecured loans total 491 million with near-term maturities in 2026 and longer dated paper extending to 2050. The weighted average coupon is roughly 80.4%, and the average maturity is 4.5 years. With equity market capitalization under 20 million, recovery potential sits squarely with senior creditors. The structure limits flexibility and reinforces the need for a debt-led solution. Okay. Now we come to the business plan. The first pillar of our business plan is the balance sheet reset. OPI must convert a portion of unsecured notes into equity and refinance near-term maturities, reducing total debt from $2.4 billion to about $1.3 billion. That reduction would lower annual interest expense by $70 to $90 million and extend maturities past 2028. Liquidity preservation is critical. Dividends should remain suspended until debt service coverage exceeds 2 times. Securing new exit financing will fund tenant improvements and essentially property upgrades post restructuring, ensuring operations can continue smoothly. The second pillar focuses on operational efficiency. Operating expenses can be reduced by 10 to 12% through centralized management, vendor renegotiation, and energy efficient measures. Non essential capital projects should be deferred to focus spending on leasing retention and asset repositioning. Predictive maintenance tools can help lower long term repair costs and avoid disruptions. With these measures, OPI should restore adjusted EBITDA to the 150 to $200 million range within 2 to 3 years, positioning it for stable refinancing and self sustained growth. The third pillar is portfolio optimization. The goal is to stabilize occupancy from 85% to above 90% by focusing on government and blue chip tenants through early renewals and flexible lease structures. Older or non strategic assets should be repurposed or divested, converting some into mixed use, life science, or logistic facilities to unlock higher value. This approach redeploys capital into sustainable, high yield assets that strengthen NOI and improve long term refinancing prospects. Once the restructuring stabilizes earnings, the focus shifts towards rebuilding shareholder value. Leverage should remain below 5 times net debt to EBITDA, and interest coverage should exceed 3 times before dividend resumption. Future reinvestment should target ESG compliant properties in growth markets and adaptive reuse projects that extend asset life. As profitability returns, OPI can reposition itself as a streamlined REIT, emphasizing operational excellence and disciplined capital allocation, capable of delivering consistent value without over reliance on leverage. Strategic alternative under. Okay.
I'll take on from Dhruv from now onwards. First of all, one of the most critical aspects in finding the valuation of the company is the TEV or the enterprise value estimation. We found out the equity market cap of the company to be somewhere around $18.5 million by multiplying the number of shares with an average estimate of the share price over the last 2 to 3 months. Moreover, the total debt balance for the company lies around $2.43 billion. So them combined, we get the TEV equal to equity value plus total debt minus the cash balance of the company, somewhere in the range of 2370 to 2380 million USD. Once we have this estimate, we reconfirm it using leverage metrics, that is net debt upon the gross assets that the company holds. Once we have that ratio itself with us, it is consistent with our estimate of $2.37 billion. So that is an underlying value of the intrinsic assets that the company holds and the market capitalization that is there. Two significant observations on this end are that the equity portion is nearly negligible, indicating that the company has a very high leverage yield. And secondly, if we put EV upon TEV upon EBITDA, even then that the ratio lies somewhere around 35 to 40x, which indicates that the current EBITDA and the net income of the company is not sufficient to justify the EV, indicating an inflated value because of the debt used. Moving ahead, during the public comparables valuation analysis, we analyze 5 different companies that either match OPI's core target audience, market capitalization, somewhere around the same operational methods, or in turn revenue and EBITDA. And while doing this analysis, we find out that although OPI might resemble in the revenue area to certain enterprises, its TEV is far beyond inflated. This leads to a very high TEV upon EBITDA multiple, as we discovered in the previous slide, showing how OPI's high leverage as well as weak equity structure limits the options that we have as a restructuring company to suggest alternatives, and telling us that majority of power, as Dhruv said, lies with the senior secondary bondholders. Moving ahead, doing a precedent transaction valuation analysis to gauge an estimate or a fair value for any of the restructuring methods that we'll be using, we analyze 5 different companies, 4 acquisitions and 1 merger, to overall see where the estimated or the median revenue and EBITDA multiples lied for the entire market. Through this analysis of 5 different cases, right from the year 2020 to very recently 2025, we see how the median revenue is somewhere around 6.5x and the median EBITDA multiple is somewhere around 11.4x, telling us what should be the actual or the optimum value. One important consideration on this end is because OPI is currently in a distressed state and is not actually doing it out of pure will or as a strategic plan, this will happen as a slight discount, indicating the haircut that will be involved in the entire process. Moving ahead, we find out about the intrinsic value of the company through the discounted cash flow or DCF model that we build. We take into consideration the company's earning potential, the capex that it has to incur, and the leveraged and the unleveraged free cash flow or FCF. And through this DCF analysis, we find that approximately $2.1 billion is the intrinsic value of assets present in the company, which is way below the debt of 2.43. Therefore, showing us that any alternative and the present value wipes out any prospects of equity and even a considerable portion of debt that we have over here. Therefore, we see how we have to be very careful and sensitive while suggesting any of the following measures that Dhruv will in his next speech, because anything could push the equity capitalization as well as a considerable size of the debt underwater in our case. Lastly, we also check liquidity valuation, knowing about the prospects of what could happen in case a fire sale occurs. If we took 5 different scenarios, right from 80% recovery rate on the company's assets to way below 40%. As OPI is a company with 124 assets spanning across multiple destinations, we do see some positivity over here in certain cases. With our overly optimistic scenario of 80% and even our base case, the implied TEV is somewhere consistent with what OPI presents itself as in the present market. However, once we test waters with the stress levels as well as a fire sale prospects of somewhere between 60 to 40% valuation, then we see a considerable amount of negative TEV going up to the span of just being 40 to 50% of the valuation, therefore implying that even these options are highly limited to somewhere between our optimistic case and our base case scenarios. Based on all the data that we have together with us from the 4 valuation methods as well as a TEV estimation of the entire enterprise, we have built a waterfall recovery analysis organizing the debt that the company has as well as the equity into 3 different tranches: senior secured, unsecured debt, as well as common equity that is held by the public as well as investors. Through this analysis, we see that in our base case, that is somewhere around $2.1 billion, our senior secured debt holders will recover approximately their 100% recovery. There will be a significant downsize if we have anything for our unsecured shareholders that will lose approximately 65% of their value, and the equity structure will be completely wiped out. The lower case shows an even worse situation wherein even the senior secured debt holders will suffer from a 6 to 7% shortfall, that is the 130 million unrecovered, while unsecured and common equity are wiped completely. The only case that shows some hope of recovery for both equity as well as unsecured debt is the high case of a valuation of $2.4 billion. Therefore, this model continuously reinforces the idea of us having the maximum possible recovery of somewhere between 70 to 80% to preserve both the debt as well as a considerable portion of the equity of the company as well. And I would request Dhruv to take on from here for strategic alternatives.
Yeah. As for the strategic alternatives, for the capital structure reset part, the proposed transaction centers on a 35 to 40% debt reduction. This will be achieved through unsecured note exchanges, maturity extensions, and new hybrid capital. Secured lenders would extend maturities by 2 years in exchange for additional collateral and a liquidity-linked cash sweep. At the same time, the company would raise between $150 and $200 million of preferred or second lien capital from institutional investors. This combination restores balance sheet strength while keeping the process out of court. It aligns with peer REIT restructurings that have achieved sustainable debt service coverage around 2 times. For the asset monetization, it is a central component of the recapitalization plan. We recommend divesting or partially monetizing 12 non-core properties across Washington, D.C., Kansas City, Atlanta, Charleston, Pittsburgh, Houston, Denver, St. Louis, and Sacramento. These markets were chosen for specific financial and operational reasons. First, they are non-core secondary geographies within OPI's portfolio with weaker transaction liquidity and slower valuation recovery. In markets such as Pittsburgh, St. Louis, Charleston, and Sacramento, recent trades have occurred at 35 to 40% discounts to book value. Holding those assets tie up capital in properties unlikely to regain pre-pandemic valuations in our near term. Second, several of these cities face persistently high vacancy and limited rent growth. Energy and tech-linked markets like Houston, Denver, and Kansas City continue to experience volatile leasing demand and shorter average lease terms. Monetizing these properties limits exposure to cyclical industries and protects cash flow stability. Third, in Washington, D.C. and Atlanta, tenant concentration creates renewal risk. These assets depend heavily on federal and quasi-government tenants, whose renewal cycles have lengthened due to budget uncertainty. Partial monetization here reduces single tenant exposure without compromising OPI's federal tenant footprint overall. Taken together, these nine markets represent roughly 12 to 15% of portfolio square footage, but less than 10% of total NOI. Selling or joint venturing these assets should generate between $500 and $600 million in proceeds. These funds will be directed to debt repayment and rebuilding revolver capacity, strengthening liquidity while preserving ownership of OPI's most stable income producing assets in Arlington, Baltimore, Chicago, and Philadelphia. On the operational side, centralizing procurement and facility management can lower costs by up to 12%, and suspending dividends until 1 year of debt service is covered ensures liquidity discipline. The out-of-court approach is strategically superior. It avoids the reputational damage, tenant loss, and valuation erosion typical of bankruptcy. A restructured debt stack with hybrid capital restores market confidence and lender alignment. Overall, the plan positions OPI for refinancing within 18 to 24 months while maintaining REIT compliance and operational continuity. The implementation follows three clear phases over 18 months. Phase 1, balance sheet reset, covers the first 6 months, executing debt exchanges, extending maturities, and raising hybrid capital. Phase 2, portfolio monetization between 6 and 12 months, focuses on asset sales and joint ventures with proceeds allocated to debt repayment. Phase 3, operational optimization from 12 to 18 months, finalizes cost reductions and strengthens cash reserves in preparation for refinancing. By completion, the total debt will decline by 35 to 40%. Maturities extend beyond 2028 and coverage will improve above 2 times and occupancy stabilize above 85%. To conclude, OPI's core challenge is leverage, not operations. The business remains anchored by government tenants and stable assets, but is constrained by an unsustainable balance sheet. A controlled creditor-backed recapitalization that reduces debt by 35 to 40% achieves meaningful deleveraging while preserving asset value and tenant confidence. It also keeps the process out of court, avoiding forced asset sales and reputational damages. If implemented as planned, OPI can emerge within 18 months as a leaner, financially stable REIT capable of refinancing on normal terms and restoring long term investor confidence.
Thank you so
Thank you so
much.
much.